Welcome to the ACCA December 25 Preseen Material Analysis. Now, the case name in this Preseen is called Levwell Business. Now, it's a hotel company. Now, in our entire Preseen analysis, I prepared you with the Preseen application notes, or PAN for short, covering these 16 chapters. Now, firstly, I will go through the important information from the Preseen by linking with lots of real-life complete information, because my view is this: the ACCA has done us a favour by releasing the Preseen material in advance. That does not necessarily mean that we simply summarise from what happens from Preseen, but we need to learn the practical ideas so we can use these thoughts into our answer later on. That will bring your answer to life, and the examiner will give you more marks. So that's why later on we'll also cover the macro environment analysis using the PESTEL model, followed by the micro environment analysis, which means the Porter's 5 forces model. Now, in this particular company, we also need to look at different risk strategy, so possibly I will link with the Tara model as well. But using a more holistic approach to managing risks will also be important. So that's why we will be covering that in Chapter 5. Now, Chapter 6 about technology and data analytics will be vital in this industry, because as you can see, the customer name in this industry is called guests. There would be lots of data that we need to store about each guest. Now, if you are in breach of the GDPR, which means the General Data Protection Regulation in some of the countries, this certainly be a disaster, okay, for our group, because our company is a public listed company. So this will ultimately affect our share price. Now, internal control always been tested in each and every exam, and Chapter 8, talent management. Now, in this particular case, I will heavily focus on the talent management, because we can see clues from the Preseen about the staff turnover ratios not being so low. We may be performing some of the strategic change, we'll cover that later on, and the governance issue, environmental issue, project process management, culture, leadership, and even the finance topics as well. Now let's go through the first section in this Preseen is the introduction. Now, we are called Levwell plc, it's the public listed company in the country of Iceland. It's a fake country just to avoid political issues. We own and operate 35 4-star hotels in our country. So what if we expand overseas? And of course, the Porter's Diamond model may need to be used. But I believe that something that is more important to learn from the experience from other popular hotels. So that's why I would like to take you through to our Chapter 1 knowledge, which means our Preseen application. Now, I would say that the first type of hotel that we can be focusing on is the asset-light hotels. A very good example, I would say that I personally like the Four Seasons Hotel. Now, the Four Seasons Hotel would be the 5-star hotel. However, the Four Seasons Hotels would not own these hotels themselves. What they did is that they would like to use the management contract to collect the management fees each and every time. Of course, the advantages of doing that, one of them will certainly be during economic recession, they can still collect stable cash flows. And this will not affect their ability to expand globally. Now, of course, currently, that Levwell plc is operating in a completely different model. I would say that it's more of a heavy asset model. Now, the heavy asset model, the disadvantage is that if you were to operate a hotel on your own, if you need any renovation, you will need to spend quite a lot of costs in that, and you will need to think about the funding options and so on. So that could be a major problem to restrict your abilities to expand overseas. Although I know that Levwell PLC has got its own characteristic that, for example, not following the standardized design across all of its hotels. Of course, that would be the selling point, or one of the selling points, I would say, but you will need to think about your business model on the exam day. Now, of course, the second type of hotel is the Holiday Inn. I would say that these hotels are quite standardized indeed, but why would that be a concern for our Levy PLC? Well, my view is this. The Holiday Inn may attract the middle class client or guests to check into their hotels. So that means that it has the very similar client base, such as what Levwell PLC currently has. So if that's the case, then we'll need to consider the actions from the Holiday Inn in order that we can protect our existing client base. But to compete with it, we'll then later on look at the tactical management or the strategic management strategies to deal with them. Another type of hotel, very similar to the Levwell PLC, is called the Peak Group. As we can see there, the Peak Group using the owner-managed business model. Of course, 4-star to 5-star experience, and a bit luxurious, I would say that. And of course, it certainly has its own characteristic. For example, being seen as a localized hotel, but of course, using an owner-managed business model would certainly restrict its ability to expand overseas or expand globally. It really depends on the risk attitude and the expectations from our major shareholders. I would say that quite a lot of shares are currently held by the institutional investors in our company, which means the Levwell PLC. So we need to watch out, okay, about the dividends that we are going to be paying to those investors and the expected return on their investment. So that's why on the next page of our Preseen application, I would like to introduce you a particularly popular hotel. It's called Marriott. Now, Marriott International Hotel, such as this, okay, or JW Marriott. Now, Marriott Hotel started in 1927 by JW Marriott and Alex. And then their son, JW Bill Marriott, okay, listed the company onto the stock exchange. But in 1993, it uses the way to split the company into two. One is the Marriott International, and secondly is the host Marriott. Now, what it did is a financial strategy is called the merger, which means to split one company into two. And the way that it uses is called spin-off, which means even though that is split into two companies, the shareholdings of each company to the existing shareholders would just be the same. Simple as that. Now, the reason why it did that is because Marriott would like to retain more funds and to concentrate the idea on the hotel operation. And then it uses the way to franchise its brands to others, allowing others to build their hotels, but using Marriott's brand. Now, what they did is to get rid of the heavy assets, which means the property itself. Because you think about property, like lots of depreciation expenses would certainly affect profit. That would be one of the major costs that you need to consider into that. So that's why it spun off the company into two, where the host Marriott business, which means the second business, would be managing the property itself and converting that business into the REIT trusts, Now, what do I mean by REITs? Would be the real estate investment trusts. It certainly have lots of advantages, I would say, because in the Preseen, currently, we are told that most hotels in this industry are using the sale and leaseback model. Now, which means we would like to get rid of the heavy asset, we sell it. We've got lump sum of funds and we lease it back. It's a clever idea, but the main disadvantage of doing that is that you cannot enjoy subsequent or later capital appreciation. Now think about it in this way. What if the property price increases later on that you sold that property to others? You cannot enjoy that gain because you've sold that already. But of course, you lease it back, which means you will pay the fixed rental payment each and every year. It's fine there. However, Marriott use a different way. It converts the entity into a REIT trust, which means you can think of like that we would like to divide the whole company into many shares and sold these shares to different investors. And of course, they can get fund, and at the same time, if the property price increases, of course, the share price will certainly increase. Share price increases, investors can sell the shares to others, to other investors. Alternatively, Marriott can also enjoy the increase in share price because Marriott will certainly hold shares in this particular company. Okay. Now, by doing that, of course, it helps the company expand globally. Now, firstly, when we talk about the assets-light strategy, of course, that is a trend in the hotel industry. Although it's not clearly mentioned in the Preseen except the sale and leaseback model. Now, firstly, what Marriott did is to transfer all heavy assets to the new entity. That's why it cleans its balance sheet, which means that if you would like to do something new, because you've got low non-current asset or NCA for short, this would ultimately increase your return on investment indicator, which means the ROA indicator. At the same time, that you retain your important brand names. So when we think of the contextual features according to Bargain and hopefully when we are changing something on the exam day, so you can always think about what to preserve, what to retain. So retaining your brand, which means in our Preseen it's called Levwell's brand, is very, very important because it can ensure high margin, low capital needs brand that we could operate independently. Okay, we can make more decisions, not restricted by limited funds that we need to retain for the heavy asset renovations and repair, maintenance and so on. Of course, when you talk about the implications, which means the next step onward, the JW Marriott subsequently using the franchise way, allowing others to build their hotels, but using our brand. Now, what it did is that firstly, it will charge a lump sum of the initial franchise fee, followed by like 5 to 10% of your revenue as the subsequent franchise fee. Of course, Marriott, as you can see, is the brand, well-known brand, expanded globally. This means it can ensure its high efficiency expansion because when you're expanding overseas, that you use the franchise model and low capital expenditure because it's up to the owner who builds the hotel to spend their money out. At the same time, through management contract, that Marriott can get very stable cash flow into the business. And that's why that is more stable than rental income if you were to use the sale and leaseback option from the Preseen. Alright. Now, as I said, when we talk about the rate-based model compared to the sale and leaseback model from a Preseen, as we can see. Now let me just to take you through to the Preseen, to page number 6, as we can see that we've got the sale and leaseback model, as we can see there. But using the rate way, that you can see that there will be lower marginal expansion costs. Okay, that you don't really have to pay very high rental fees each and every period. At the same time, you can share property appreciation, and also very importantly for the public listed companies, that you will result in higher PE valuation. So PE, which means the price earnings ratio. This is particularly important because in order that you can convert into REITs, which means the real estate investment trusts, you will need to prove your business model is profitable and with other stricter conditions attaching to it. And that's why that could be seen, or the investors will find it very useful and will favour it. So you will easily attract a lot of funds from these investors. Now, you may have a question. Well, if I were to expand overseas or globally, or expand my business further from Levwell's PLC's perspective, I need cash. Yes, by using this way, you can get lots and lots of cash. So, what to do with the cash? Now, looking at Marriott again, it subsequently performed the M&A, or the mergers and acquisitions, back in 2016, about $13 billion, buying a very famous group. It's called Starwood Group. Now, Starwood may not be very famous or popular. However, you may have heard of the name or the sub-brand within the Starwood, such as Sheraton and also W Hotel. So, it's a very large hotel group all around the world. Now, what Marriott has done is to use debt to buy Starwood company, of course, combined with share-for-share exchange and even cash consideration as well. Now, if we were to discuss about the potential M&A or mergers and acquisitions in the actual exam, about the potential impact, we can see that in what way that you are buying the target company. You may be buying using debt. Now, debt is very important. You will need to manage your cash flows very closely, very carefully. The reason is, if you were to use debt, you will need to care about firstly the interest payment in each and every year, and also the repayment of principal. At the same time, you also need to consider the potential synergies, which means 1 + 1 = 5. Where is the additional $3 coming from? Perhaps you may be combining the IT, purchasing and management teams to avoid duplications. At the same time, it may increase your market share. So for example, what Marriott did is that after combining with Starwood, it really increases the hotel to more than 5,700 and more than 1.1 million rooms. So increasing the market share in this industry. Not only for that, you also need to consider, for example, the brand diversification. Not only is that we are only covering the 4-star hotel targeting, for example, the mid-level customers, but also we can target more high-end customers or even budget customers. We can introduce very strong loyalty programs. Now, at that time, Marriott Rewards and the SPG, which means Starwood Preferred Guests scheme, is just to be a loyalty program. However, that you will need to integrate them to avoid double booking and the expiry of the loyalty points and so on. So that would really involve lots of complicated data integration technologies. Now you also need to consider the culture shift. Okay, so instead of making your decisions using a top-down approach, perhaps using a bottom-up approach now. Now, you also need to think about, after the M&A, are there any impacts onto the franchisees? I will say that the answer is certainly yes. So for example, after we've got stronger power because of the M&A or merger and acquisition, that I can negotiate with the online travel agencies. So for example, Booking.com, I use that quite a lot to book hotels. So I can tell them, please do not increase the fees that I pay to you, okay, if someone books the hotel using your platform. If you don't follow me, of course, you cannot sell my hotels onto your platform. At the same time, more bargaining power over suppliers regarding the procurement of their cleaning product, food and drinks. And of course, we can also think about the standardization issues. Alright, so after the M&A, so for example, to coordinate real-time room availability and even to centralize reward program. So as we can see, it's a common topic in this exam related to M&A and potential franchise way that we can grow the business. But not just for that. Let me give you just to be the high-level summary. I've predicted lots and lots of areas each and every time in the SBL Preseen application. I helped many students pass the exams. So, the high-level summary this time is related to the strategy. It's related to the strategy for our Levwell company. As you may have heard of in your tuition studies, that when we are setting up a strategy, we can always divide that into 3 levels. Strategic level, looking at the longer term plan, possibly more than 5 years ahead. The medium level is called the tactical level, which means how to compete with your competitors in setting up your prices. And also the everyday plan, which means the operational level, by looking at particularly the various analyses. Now, firstly, related to the strategic level, I will say that the focus point, if I am the examiner, I'm not the examiner for the SBL, but if I were to help Levwell PLC to expand, firstly, I would heavily focus on the asset-light strategies. So what I would do would be to keep the flagship property owned by myself. However, for the new locations, I could use the franchise ways to grow. At the same time, I would like to use either the sale and leaseback or the REIT way, the converting that like Marriott into a new entity and keeping the assets light so I can have an entity that focusing on the hotel service provision, but another entity would be responsible for managing its property. And possibly, I would probably choose the REIT way so I can also enjoy the capital gain in the near future. Not only for that, for the strategic part, I'll also focus on the sustainability issues. The reason is because we as the 4-star hotel, we can't simply compete, we've got the bed and you come to us, which means the bed for the night. Because this industry, as we can see, lots and lots of hotels all around the world, is a highly competitive market. So that's why I would like to learn from a real hotel case called Scandic Hotel. Now, Scandic Hotel, that having very clear roadmap to sustainability, that we can learn from that. So for example, setting up the important target related to carbon emission, water usage, waste and the community impact. At the same time, turning each hotel into more of a local experience hub. So for example, let's have the nature walk, let's have the cycling, let's have the coastal activities, let's have the local food, let's have the wine weekend, and so on. And also, standard that needs to be set. For example, heavily focus on green energy. Because as we can see, Covenant, that we are not only the public listed company, but majority of shares are held by the institutional investors. We may need to think about ways to manage our market capitalization by allowing other investors to invest their money into buying our shares. Now, one of the ways that we can do is to allow our company to be collected by certain famous index. So, for example, related to the sustainability stuff. By doing that, of course, these other investors will automatically inject fund or to allocate part of their fund by investing in these trusts if we are within that index. And the final way related to the strategic part will be to focus on the data stuff. Because as we can say, the data protection regulation is so important in this industry. Marriott has been fined by EU in a few years ago about the data breach. I would say they're fined heavily. So this is why it's very important that we focus on currently in our business. We've got a very basic in-house IT systems. It is less vulnerable to certain attack by the hackers. So that's why we may be thinking about to switch that to more of a cloud-based solution or the platform. Because by doing that, we could integrate the AI-driven demand forecasts, and even that we are not or be less likely to be in breach of the potential general data protection regulation. Because if we are hacked, data may be leaked and we may be fined. So by using this, like what Hilton has done, it may ultimately increase the revenue. Of course, in the next part, I'll also tell you about the tactical strategies by focusing on the loyalty, dynamic pricing, and even talent management by retaining our staff, and even the operational strategies, for example, to improve our processes and how to put sustainability into the operational stuff and how to put the cybersecurity stuff into the operational part. I will leave these to the next parts of our studies. Hopefully, when analysing the first part, although it's just to be the introduction, I've given you lots and lots of information from the Preseen already by giving you some of the important ideas that you can learn from. And I look forward to seeing you soon in the next part and your exam success. Bye-bye.
ACCA, accounting for your future.